Financial management for entrepreneurs. Introduction. Every great business idea, no matter how innovative, rises or falls on financial management. You could have the best product in your community or the most creative solution to a social problem, but if you don't know how to manage money, your idea might never survive long enough to make an impact. For young entrepreneurs 18 to 35 years old, worldwide, whether in Africa, Asia, Europe, the Americas, or beyond, financial management is not just about bookkeeping, it is about survival, growth, and sustainability. This module will give you practical tools to help you manage costs, price your products or services correctly, calculate profits, and maintain positive cash flow. It will also equip you with simple bookkeeping methods to track your progress and prepare for expansion. Let's dive into the essentials of financial management for entrepreneurs. 1. Why financial management matters. Financial management is the backbone of any business. Without it, you may run out of cash even if you are making sales. You may price your product too low and lose money without realizing it. You may spend money on things that don't bring value to your business. You may not be able to convince investors or banks to support your business. For young people starting out, understanding money management helps you avoid mistakes early, build credibility, and position your business for long-term success. It also teaches you how to apply financial literacy in schools and communities, since you will be modeling the very practices you are teaching. 2. Costing, knowing what it takes to deliver your product/service. Costing means identifying everything it takes to produce and deliver your product or service. Types of costs. Fixed costs, expenses that stay the same regardless of how much you produce, e.g., rent, internet subscription, licenses. Variable costs, expenses that change depending on production or sales, e.g., raw materials, packaging, delivery costs. Hidden costs, often overlooked costs like equipment maintenance, electricity, or even your own time and labor. Example. Imagine you run a small bakery. Fixed costs, $300, shop rent, $50, electricity. Variable costs, 50 cents per loaf of bread, ingredients, 20 cents per loaf, packaging. If you bake 1,000 loaves, your costs equals $300 plus $50 plus 70 cents times 1,000 equals $1,050. Knowing your total cost allows you to set a price that covers costs and generates profit. 3. Pricing, setting the right price. Pricing can make or break your business. If you set it too high, customers may walk away. If you set it too low, you might lose money. Strategies for pricing. Cost plus pricing, add a profit margin to your total cost. Example, if a loaf costs $1 to make, add 30% equals $1.30 selling price. Value-based pricing, charge based on the value your product provides. Example, a health smoothie might cost $2 to make, but if customers believe it helps them stay fit, you can sell it for $5. Competitive pricing, study the market. If others sell bread for $1.50, you can price yours at $1.40 for affordability or $1.60 for premium quality. Golden rule. Always make sure your price covers cost plus profit margin. Even if you want to be affordable, don't sell at a loss. 4. Profit, the reward for your risk. Profit equals total revenue, total costs. Revenue is the money you earn from selling goods or services. Costs are everything you spend to run the business. Example. Total sales, $2,000, 1,000 loaves sold at $2 each. Total cost, $1,050. Profit equals $950. Profit is what allows you to reinvest in your business, pay yourself, and sustain growth. But remember, cash flow is as important as profit. Let's see why. 5. Cash flow, keeping money moving. A business can be profitable on paper but still fail due to poor cash flow. Cash flow means the movement of money in and out of your business. Types of cash flow. Positive cash flow, more money is coming in than going out. This is good for growth. Negative cash flow, more money is going out than coming in. This can lead to debt or business failure. Example. You sell bread to schools and they promise to pay you after 30 days. On paper, you made $2,000 in sales, but in reality, you have no cash to buy flour tomorrow. That's a cash flow problem. Tips for managing cash flow. Ask customers to pay upfront or shorten payment terms. Negotiate longer payment terms with suppliers. Always set aside a cash reserve, emergency fund. 6. Bookkeeping, tracking your business money. Bookkeeping is simply recording every transaction in your business. Without records, you will never know whether you are making progress or losing money. Why it matters. Helps you make informed decisions. Makes it easier to apply for loans or grants. Prevents theft, fraud, or careless spending. Gives you peace of mind. Simple bookkeeping tools. Cashbook, write down every income and expense daily. Excel/Google Sheets, free digital tools for tracking. Mobile apps, apps like Wave, QuickBooks, or free accounting apps in your region. Basic records to keep. Sales, income. Purchases, expenses. Debts owed by customers, accounts receivable. Debts you owe suppliers, accounts payable. Cash at hand and in the bank. 7. Common financial mistakes young entrepreneurs make. Mixing personal and business money. Always separate your personal expenses from your business money. Ignoring small expenses, it's just $1 adds up quickly. Track everything. Overinvesting too soon, don't spend heavily on expansion without stable profits. Relying only on loans should support growth, not survival. Not saving for emergencies, unexpected events can kill a business if no buffer exists. 8. Practical exercises. Calculate costs, write down the fixed, variable, and hidden costs for your current or future business. Set a price, using cost-plus pricing, calculate a fair selling price for your product/service. Track cash flow. Keep a daily record of all income and expenses for 1 week. Role play, school application teach students to run a mini business project, like selling snacks. Help them calculate costs, set prices, and track profits. 9. Case studies. Case study 1, a young fashion designer in Nigeria. Amaka started making t-shirts with local designs. At first, she sold them cheaply without calculating costs. Later, she discovered she was losing money. After learning costing and pricing, she raised her price slightly, covered her costs, and started making real profits. Today, she employs 3 workers. Case study 2, a student entrepreneur in India. Rahul created an online tutoring service. He tracked every rupee using Excel. When an investor asked for financial records, Rahul could clearly show income, expenses, and cash flow. The investor funded his expansion. Case study 3, a bakery in Kenya. A youth group bakery had great sales but kept running out of cash. They realized schools delayed payments. They introduced a policy where at least 50% must be paid upfront. This improved cash flow and kept the bakery running. 10. Application in schools and communities. As a young leader, you can teach financial management to students by running a mini business simulation, school tuck shop or fundraising event. Teaching them to record daily transactions. Helping them see the difference between profit and cash flow. Showing them how to price products fairly. This way, you not only build your own entrepreneurial career but also empower the next generation to avoid financial mistakes. Conclusion. Financial management is the compass that keeps your business moving in the right direction. It helps you understand costs, price wisely, generate profits, maintain healthy cash flow, and keep accurate records. For young people aged 18 to 35 across the globe, mastering financial management ensures that your entrepreneurship journey is built on solid financial discipline.